Welcome into another Tax Talker. Today we're taking a break from the tax code weeds and we're jumping into a lighter topic, NFL free agency. Big contracts are flying around, teams are wheeling and dealing, or undealing if you're the Baltimore Ravens, and every year you hear versions of the same thing. The states with low income tax or no income tax have an unfair advantage. They get all the free agents. That's why he went there. But is it really that simple? Is that what the data tells us? Is that what our eyes tell us? Let's get into it. On paper, this should be a pretty big deal. These players sign contracts worth tens of millions or hundreds of millions of dollars. So even a small tax rate difference can mean a big difference. And we're not even talking small tax rate differences in some cases. Take Mike Evans, who just went from Tampa Bay Buccaneers to the San Francisco 49ers. On paper, he's going from a 0% income tax state to about a 13% in California. On just the guaranteed portion of his contract alone, that's $16 million. And the tax difference on that, 13% versus 0%, is over $2 million. So did Mike Evans' agent drop the ball? And taxes should be a big consideration here. In economic terms, in a salary cap league, this should be a huge advantage. This should be a Moneyball-esque advantage. Where's the Michael Lewis book about this? Well, the data is pretty mixed on this. Economists can argue back and forth. One of the more bullish versions of this comes from a guy, Eric Embre, I don't know if I'm pronouncing that right, out of the University of Illinois. He argues that higher state income taxes does correlate with worse team performance, and a component of that would be obtaining and retaining key players. Even here, he's emphasizing this is very much at the margin. And you have others that will argue with evidence that taxes aren't really decisive at all. That also intuitively feels true, anecdotally. It's not like the Dallas Cowboys and Jerry Jones are mopping the floor, soaking up all the free agents every year. Certainly the Dodgers over in baseball aren't having trouble getting players to come to California. But how can that be when some of the on-paper tax differences are more than you or I are going to make in a career? Well, first, it's how the taxes actually work. Professional athletes don't pay taxes just where their team's located. Like all income, their income is taxed where it's earned. And for them, that's where they play the game. Now, technically, this rule exists for everyone. Income is taxed where it's earned. But for most of us, a short business trip doesn't trigger a new tax report in a new state. We're just not over the threshold. But for professional athletes, it does. This is called the jock tax. States can enforce this aggressively because the numbers are so big and their schedules are so public. And so for even those players playing in Texas or Florida, all their road games, they're going to file taxes where they're playing the game. And the income isn't even split by games. It's allocated using something called duty days. And a duty day includes practices, travel days, meetings, and the games themselves. Each state gets a slice of a player's salary based on the duty days that happen in that state. And so suddenly the idea of signing with the Dolphins and playing in tax-free Florida gets a lot murky. But all that said, once you account for road games and this multi-state allocation, the advantage of signing in a no-income tax state shrinks, but it doesn't go to zero. Still take those extremes, going from California to Texas or New York to Florida. That should still save 5 to 7 percentage points on your income tax. And that can be a big number, but think about all the other items that are in these contracts. You have the contract length, the guaranteed money, the signing bonuses, and you also have the outside of contract, like how much money you can actually earn in that market with all the endorsement deals. Is this a national market? And then you have the non-financial considerations like team competitiveness, the quality of life, the so-called hometown discount. Agents will tell you taxes are part of this, but they're one line item in a very complicated decision tree. If taxes were a deciding factor, the most attractive division in football should be the AFC South. The Texans, Titans, and Jaguars all play in no-income tax states. So if you go play in one of their teams, you also have a bunch of road games that are also tax-free. In Indiana, the Colts, the other team in that division, they have a flat tax that's not even 3%. So you're talking 11, 12 games a year that are no income tax or really low income tax. And yet the AFC South has not exactly dominated the NFL over the last couple decades. Agents and accountants can run numbers and spreadsheets, but most players are dealing with a tax system that's so complicated that it's hard to intuitively understand. When your tax returns involving these things called duty days and you're filing in 12 different states, so-called tax savings can feel a lot more opaque and can just be one number in this big report the agent gives you comparing two possible contracts. That's not to say a player wouldn't choose taxes, and we certainly have anecdotes to that effect, but it's a preference in the same way a player wants the limelight in New York, or to play for their hometown team, or they want to play for a contender. And the bigger takeaway here is something everyone can relate to. Taxes do not usually map onto everyday life decisions. And adding a few extra zeros to the contract does not change that fundamental reality. But I'm curious what you think. Does this matter more than I'm giving credit for? Is it the thing holding your team back from winning it all next year? Or is this basically a rounding error that team loyalists will use as a dumb excuse? Let me know in the comments, and let me know what you thought of this video. This is a break from our normal format where we're trying to make everyday tax issues more understandable to you. But if you like this video, I got more where that came from. And if you don't like it, let me know what your tax questions are. Leave them in the comments below. Thanks for watching, and I'll see you next time.